I think most investors are doing a little bit of both. The data does not show that any segment of investors, whether you're talking about institutions, hedge funds, retail, family office, foundation, there is nobody out there right now acting in word or in deed as though it's 1999. You just don't see that form of euphoria out there in the market. Do we have stocks that are extended? 100%. We're up 11% above the 200-day moving average in the S&P. That's somewhat close to an extreme. 4 out of 5 stocks are above their 200-day within the S&P. That's somewhat an extreme. So wouldn't surprise me at all if things get a little bit overblown and then short term there's a pullback. But I really just don't see people running around screaming about a new paradigm and everything is different.
Well,
anecdotally,
okay.
I don't see it either.
All right, that's fair. But let me throw this back at you, okay? Month-to-date gains. Beyond Meat, 59%. Smile Direct, 53. Tesla, 30. Tilray, 24. Uber, 23. Last week, we had a fund manager talk about Tesla 6,000. Those are certainly signs that you would say, well, maybe that's a bit of euphoria. The question is to the group, Steph, is whether this cocktail, if you will, that PTJ speaks about, of fiscal and monetary policy has us so intoxicated that we eventually fall over hard.
But I don't think we're going to fall over in the near term. I think a lot of this all has to depend on earnings and earnings growth. And, you know, we've talked about earnings growth, how I think it's going to be better than expected this year. A lot of it has to do with business investment, business confidence. And if you listen to Brian Moynihan this morning, the CEO of Bank of America, he actually said last year small and medium businesses actually did invest. It was the large companies that did not because they were impacted by global trade and global uncertainty. So to the extent that trade it's a detente, resolved somewhat, and you have global growth stabilizing, I think you are going to get business investment. Therefore, that will lead to better earnings. And I think there are pockets in the market, energy, financials, healthcare, that are still very attractive.
All right. Sarat, Edward Yenning sat here last week, said he's getting a little nervous, right? He calls this the fly me to the moon market. Those lyrics could easily be about an investor frolicking in today's stock market as a fellow smitten by love. Credit Suisse, more upside than you think. They bumped their price target on the S&P up to 3,600. Okay, 8.1% upside from current levels. What's this mean?
So I'm going to echo what you said. I mean, I think there's a lot of value in this market that investors are in, but they're really starting to chase. Again, we're seeing this story again on these high-flying stocks, the ones you just mentioned, the 5. They're up 30, 40%. Stocks that
I could have mentioned a ton of other ones.
And I think you have to be really careful as an investor to say don't fall in love with just one part of the market, which is stocks that are trading on price to sales, that are trading on 30% expected growth for the next 5 years. You need to rotate, you need to manage your risk, and you need to have exposure to areas that have better fundamentals like financials, some energy, some healthcare, and you can't just be, 45%, 50%. And that was 99 when people were 40 to 60% in technology and said, I don't want to touch the value side. And in the next 3 years after that, value actually had positive return.